Wait a minute. Okay, so it looks like you didn't even get to hear me in the beginning, which kind of sucks, but that's okay. So I know you're going to be able to hear me now, but so basically what's going on here is we've got Jerome Powell interest rates stayed the same. He didn't change anything. Now we have to see how the metals market reacts. We have to see how the precious metals, along with commodities, we have to see if crypto will retrace here initially and then start pushing up again. So we're going to see exactly how that's going to play out. Yeah, I forgot when I played on my other camera, you can't hear me. So that's what we're looking for. So please make sure to hit that like button, as it will greatly help push this content, allow as many people as possible to reach us here and watch this with us. So good mid-afternoon, 2:29 p.m. Eastern Standard Time on this Wednesday, January 31st, 2024. I'm XRP Future Millionaire, and I reside in the great state of Michigan. So real quickly before we start this, as we can see, I talked about on the midday market report how I felt like metals were telling us something that it was going to go down after they stayed the same initially. We don't know if that's going to continue, but that was something that I was just still waiting on. We went all the way up to 2058. Now you can see very quickly we came down to 2040 area. I don't think that's a surprise. Crypto came down initially, but we'll see if this is the retracement here. And now that they stayed the same, if we start to get vibes that maybe we could start moving up. See, we're going to have a bull flag set up here a little bit with XRP. So let's say it comes to like 504, even this 494 level. Anything that stays above here, technically, this could be perceived as a bullish Gartley, which means that we came down a little bit on this right side, and we proved to the bears that there was a lot more strength there. Even after a huge pull down, we pulled it back up with a quick wick. And that's what we're kind of looking at here. A lot of room here to run up still. Looks like it bull flagged out here a little bit. So I would be shocked now that it stayed the same if we don't get some volatility. Maybe a little more to the upside. And maybe it tries double tap or triple tap now, the 534. But if we look at it from a 3 hourly, we're still oversold. It will actually come back into the slightly lower neutral levels. But it's got a lot of room to run. So here's Jerome Powell. I won't interrupt. If you have any questions, please ask, and we'll take a look at this here and there. So here we go.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points,
look at that.
and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
So basically, to sum it up, he's told us absolutely nothing. Again, he's got to review the data. There's always some reason why he can't give us a straight answer, but as you've seen, the funds rate is unchanged, and he's basically saying that we're doing a good job against inflation, which could not be farther from the truth. I mean, let's just be honest. If you're watching this, please make sure to hit that like button. 43 people are watching, only 22 likes. I would greatly appreciate it if you do hit that like button as we continue on here, try to expand our audience. But as you can see, a lot of the audience is tuned out. A lot of what's going on now. A lot of the people that are within the crypto community have just given up. And a lot of people are stepping away when it's actually a very inappropriate time to stop trying to formulate what you're trying to do through 2028. This is why I say oftentimes that the ones around, you're just not going to see them in 2028. Most of the people, I believe 75% of the audience won't make it there. For one reason or another, they're not going to make it to 2028. And we've seen about 25% already to start 2024. The tide is turning mentally to the dark side. So go against the grain. These are the best times to start looking against what everybody else is supposedly seeing, and the fact that now all of a sudden it's dead. Like you seen the drop yesterday, and isn't it convenient that Christian A. Larson's came out and said he was hacked, and yada, yada, yada. So what the hell is really going on, and why are they so desperate to grab that bottom side liquidity? Is something bigger going on that's outside and unseen? That's what I want to know. Rock and XRP, welcome in.
Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay, so what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and it has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact...
I mean, are these people out of their minds? Good data. We haven't had a single bit of good data. Their goal is 2%, even admittedly, even with their lowballing, the same with 3.1%. It's nowhere near 2%. Not just that, a lot of their good data is saying because consumers are spending more money. No shit, Sherlock. Things are 10 times more expensive. Well, let's not get that far. But you're talking 15, 20% increases on pricing, if not more, across the board. How many things have you seen in the store double and triple? Of course we're spending more money, and our credit's also becoming less because we're becoming overextended. You know what happens when a society becomes overextended? You stop buying these goods. Well, when you stop buying the goods and you don't produce anything, that's a recipe for disaster. That's like me telling you, you've got a $500 a month payment you got to make your credit cards, but you have a $50,000 credit limit. Well, now once you get up to $50,000, you still got to pay the $500, but you can't extend the credit anymore. Now you're at a catch-22 if you have no more income that can be made. We're being played through the loop.
On a path, a sustainable path down to 2% inflation. That's the question. And the answer will come from some more data that's also good data.
Always more data.
It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably under 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. If you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry, if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, You can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing and that tells us that we are on, gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick.
So just say you don't know. There's nothing that anybody can say, no data you can see. That's all.
Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3
when real
months from now
inflation's over
that
12,
you have
I mean-
avoided those two risks?
So,
First of all, if anybody was asking him a real question, and I won't interject anymore, they would say, well, you're saying that we've done all of this, but haven't we expanded the budget? Aren't we more in debt today than we were 2 years ago when we started this whole fighting measure? That this is lunacy. This is like me saying that I paid off a $100,000 credit card loan by taking out another $100,000 credit card and now owning $200,000 of debt, but I paid off the initial debt with more debt. Like, are we out of our minds? And now we're paying it with higher interest. Like, we are truly in bizarro land. That's why nobody likes to watch in these times. We're in bizarro land. Unless everything's going up, nobody wants to watch. When everything's going down and they're getting the opportunities, nobody wants to see anything. But when everything's going good and you shouldn't be buying because we're topping out, everybody and their mother's out. Everybody's here saying it's the best thing since sliced bread. But while the bread's being sliced, nobody wants to partake. They just want to pick up the crumbs. I mean, if everybody just wants to pick up the crumbs, let them. You dedicate yourself.
as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down. Growth has been strong. The labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back to 2% so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our teal book and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is implicitly is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all because, for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is is in favor of moving rates down this year. But the timing of that is going to be linked to.
Matt, you and me both. It's coming to a point where the frustration is just on a grand scale. Like, there's not one person, because they're all the same schloozballs and sleazeballs that are all hired to do the same. They're all paid actors. It's all become a big paid actorship. Everything on TV, everything when they're asking these questions, even in sports entertainment, it's all become paid actors. That's it. Everything's one giant script. And it becomes tiresome. It's also become tiresome when you see one giant script and everybody comes in when they tell you to and everybody leaves when they tell you to ignore it. And I can't believe how often the script is written. Right now, everything looks bearish. You know why I'm more interested in crypto right now than I was 2 months ago? The amount of people that care about it. When 75% of the people that are searching for XRP or for crypto in general on YouTube are disappearing, it tells you that you should start paying attention. When 1/4 are looking in this direction and 3/4 are saying it's shit. When all of the news outlets are telling you not to own it, when they told you the Bitcoin ETF was the next greatest thing since sliced bread, but we turned out that we knew we were buying the rumor, sell the news. It was so obvious. There's a reason why all this happens. It scares everybody away, and then out of nowhere you get a gigantic bear market rally that'll punch you in the face, and by the time the general folk come back, it's already reversing back down, and they legitimately pick up the crumbs. And as one said, you can still make breaded steak out of crumbs, and I agree because I love breaded steak. But in this case, you know, I mean, maybe you get an ounce of steak, and then you got to give back 15. Like, that's the problem. But it's just, I think it's insulting to one's intelligence to see how many people don't show up when the getting's good, and how many people come out of the woodwork when it's all but over. It makes you want to bash your head through the wall on a daily basis. And I know everybody who sits here day by day understands what I'm saying.
Our gaining confidence that inflation is on a sustainable path down to 2%.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated.
They will never tell us the
What's the
truth.
step down from there?
Yeah, I don't know that we worked out the particular statement language.
Right, Matt? There
I would
you
just
go.
say, you look at where 12-month inflation is, and it's, you know, it's still well above. Core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline, and you know, the case is likely that it will continue to come down. So that's where it is. But we're wanting to see, you know, more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes. So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, you know, in the base case, the economy is performing well. The labor market remains strong. If we saw an unexpected weakening in certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or
Can I ask you guys one thing? I mean, this is all bullshit, honestly. We're just wasting our time, but as some of you said, blah, blah in the comments, it's exactly that. Why hasn't he one time brought up the budget? About the expansion in the budget? How the deficit goes up month after month? How it's at an all-time record? I mean, why don't we ever talk about the budget? I thought it's about the budget. No amount of data is going to tell you the bottom line, numbnuts. Like, all we have to do is look at where we were at in 2021 and where we're at in 2024. The budget's expanded, which means inflation can't go anywhere but up. You can keep putting these artificial labels, these artificial numbers, these artificial data points. It's all bullshit. When I go to the store, milk is up $4 a gallon from the start approximately. When I go to the store, eggs are not $1.99, even for regular unorganic eggs. They're like $7. You know, I can't even go out the door without spending $50, as to where back in the day you couldn't walk out without spending 10. You know, it's a big difference. You buy a grocery cart full of groceries, it's like $400. for $57 worth of groceries back in 2020, it feels like. So all these artificial data points, like where are we getting these numbers? Why? Because the US dollar is artificially inflated right now at about 102, even though it's like 101.30, or that the nation's debt has expanded at an all-time. I mean, where are we getting these artificially lower inflation numbers? The fact that consumers are spending more money is the dumbest thing I've ever heard. Yeah, they're spending more money on food, dummy. They're not buying their local. Hey, they can't go out and buy electronics and all of their vacationing things. They're spending that same amount of money. They're spending the exact same amount of money just to buy the food now. So what is he talking about? Yeah, you're spending more at the store in the grocery section. You can't even go around the department stores within that store because you need food. Like what they're saying, it makes you feel like if people listen to this and actually believe it, they're the brainwashed ones. It's so simplistic to see it when you start living it. We are so screwed that somebody has to leech onto this, and you're going to have to provide for a big segment because at some point, nobody's going to have anything in the USA. We're going to be one big Venezuela, and everybody's going to say, oh my God, how did it happen? I don't know. Maybe because everybody pays attention to Taylor Swift on Sundays instead of praising Jesus. Could be a start.
Those sorts of things would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down, that's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Where does it end, Julie?
Claire Jones, Financial
That's the
Times.
question.
Just
Where
to
does it end?
circle back to the greater confidence aspect of the statement. There's been a lot of unanimity in recent meetings, and just wondering going forward when it comes to all needing greater confidence, is the unanimity or at least consensus among FOMC members about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rent. So, of course, we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation. So the question is, when will these lower market rents find their way into measured grand stagnant as measured in PCE inflation, and we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably. It's been giving a lot of disinflation to the effort, and probably that declines over time. But it may well have some more time to run. You know, the supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles and has brought that working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest-sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
I think it's of course that it's not something you can identify with any precision, but a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract sort of a forward measure of inflation. If you do that, there are many, many ways to calculate the neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will, but at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is when that peters out, I think the restriction will show up probably more sharply.
Thank you. Sorry. Thanks for taking the question, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market. I think you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal? And that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic. Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market, by many measures, is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think job openings are not quite back to where they were. Wage increases rather are not quite.
And it's just like everybody's laughing in the comments. I don't know what growth he's talking about. Honestly, I'm not seeing it. Julie, are you seeing any growth in the U.S. in any way? All right, so there's another person, but we're just not seeing the growth. And see, we're down to 30 people because nobody can take this guy seriously. It happens every time. Nobody will watch him to the end.
Back to where they would need to be in the longer run. I would look at it this way, though. the economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens, it's probably will take a couple of years to get all the way back. And that's okay. That's okay. But we do see, you saw today's ECI reading, the evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. The panic on the part of businesses couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year, and we were kind of thinking, well, maybe we won't get it back. And then 2023 we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to what is still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance, and that's what we want to see. And one great way to look at that is what's happening with wage increases, and you see it now across the major things that we track. It isn't every quarter, but overall there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic. And
Tanya, welcome in. I appreciate you tuning in. This is mind-numbing at best. This is mind-numbing at best. Just listening to this, I mean, every month you ask yourself, do they really think we're that stupid? And it turns out they do. Turns out they do. And the fact that very little people are interested to even watch what he's saying. I mean, if you look universally at the amount of Americans that are watching this, it's probably less than 5% of the people in the country are actually watching this press conference. I mean, think about that. It's I don't know. I really don't know what to say with the populace anymore, because the information's there and the lack thereof it as well. And if you just watch it, you can see when you're being lied to. Everybody knows when they're being conned. Does this look any worse than a telemarketer calling you on the phone and blatantly lying to your face to try to get your bank account number? I mean, this just doesn't seem right.
with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk. The risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not rushing. So I think both of those are risks. But I think the more likely risk is,
did he just play both sides
the
of the
one that I
field
mentioned, which is
and say we can
you've
up
had
and
6
down?
good months, very good months. But what's really going to shake out here?
Honestly, if you read between the lines of what he maybe is trying to say but knows he can't say, is he not admitting that things can go up? Like what I just heard here over the last 45 seconds, he's trying to stutter through this answer, but he's basically telling us like things are not what I'm telling you. That's what I just heard right now is I'm lying to you, and rates are going to go up in the very near future and not continue down. Maybe through the election cycle we'll lower it to get the vote. But after the election, you better watch out because rates are going up at unprecedented levels. Did I hear that right? Because that's what I heard.
When we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence?
Well, I can't answer that. We're going to have to wait for the data before I can come to any conclusions.
Where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
What the hell is that supposed to mean?
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below...
I'm sorry, but what could he possibly be looking at through his book when he asked if it was a hard or soft landing? Why did he flip through his book? I don't understand. Like, does he look for names? Like, oh, this is John Benson, so let me get to John Benson. Here's his predetermined question, so I know the answer because it's right below it. Like, I'm arguing now. I want to see this book. Is he like looking through names? Like, if I ask him a question, would it say XRP Future Millionaire? We talked about this beforehand, and here's how we go across. If it goes off script, we go to this guy Deborah. Like, I want to know.
percent inflation on a 3-month
Actually, this
basis.
lady Deborah, that
Core
guy.
PCE's been running at 1.5%.
all I
And
wanna
there are
know.
those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years. So it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a
Sure,
good
why
economy.
wouldn't the dollar pump
But
on this?
what's the outlook? That's
exactly what we
looking at
talked
the
about
outlook.
earlier.
We do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target is not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context. We're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think that's probably not the most likely case or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to...
It's always about the data, but yet there's never any data. There's never any data. Real quick, this is the DXY. If you're paying attention, 45 of you just got that. That's to me, that's what the DXY is in. That's your target if it breaks down or breaks up. So we're gonna have a very interesting dilemma here. If it breaks up and it goes up to 104.98, pay attention because look what it's doing in the hourly. Like if we do somehow, like I said before this, somehow this will be good for the dollar and it'll be bad for precious metals. And it's starting to take that exact omen right now. Remember what precious metals did earlier on the midday market report? We talked about it. This is uncomfortable for metals at best. And I said, this is uncomfortable. It shouldn't be running up before the meeting. It should be pulling down to support so that it can have a big breakout. But what did it do? It ran up into oversold or overbought areas throughout most of these smaller time frames. And now look what it did. It immediately pulled back. And I even said, do we know if it comes back below 2030? No. But if it breaks these levels, somehow, some way, I could see it coming to 1930, but that would have to be some special parameter with the dollar running up. And look what's happening here with the dollar. We've got this new line that we can put here. If it breaks out of this, we're going up to 104.959. That's a little bit higher than I thought. So could that give it the ability to move? I think so if it breaks up to the next level. Maybe this is just like the elevated left shoulder instead of a head formation. Who the fuck knows what they're going to do, honestly. This is where it's exciting for me. And you've just seen in real time how I try to see things from a perspective that most probably aren't looking at. And I don't mind updating smaller time frames because I'm making a prediction in my own head about how this could be an inverted head and shoulders. Everybody who was here when we talked about this with the dollar, I drew this exact thing out before it came to what looks like an inverted right arm. It's okay to call it for what it is. Think about it. Look what we're looking at here. If this did break up with the dollar, and I know Jerome's speaking, but God, that guy's so damn boring. At least you can learn something for a sec. Inverted left arm down to a head. If this turns out to be the inverted right arm, and then it comes up and back down, we're going to say, well, how the hell didn't we see that? And we'll say, oh, we did see it. We did see it. It's also like something else in the human anatomy, not the male, but well, we can't even talk these days because, we don't know what's what. But the female anatomy, that kind of looks like something if you look it up. So it's funny how all things turn into something. But this looks like an inverted head and shoulders pattern. Inverted left arm, inverted head, inverted right arm, to inverted. Could this be the shoulder if it comes way up? Who the hell knows how high it's going to go? But what it looks like is something ain't right here, just like we said going into the meeting. And now it's looking like something still ain't right, because it looks like this wants to go parabolic for a minute. And if it does, that means gold. There's a reason why those targets and things are popping up on the screen. There's a reason why B2 gold at $2.40 is popping up on the screen. I want it, but most people don't. There's a reason why everybody's going short on crypto. And all of a sudden here, somehow, some way, because of all these dumps here the last couple days, all of a sudden it's not looking as bad as it was just a few short days ago. For massive pain at the pump, and I'll continue to say this, XRP, if it could somehow find a way to meander its way up to 57, 58 cents, you could inflict a bigger drop and try to bring it down to 44 cents and then break the backs. And then when everybody's like, oh my God, I have hit it, they'll be not even realizing that there's a bigger grand setup here, because I believe what they're setting up. And I know I've had some confirmation. I think Prosperity Fund was one in the comments who agreed with what I was saying, and I agree with what he's saying, with this leverage side of things, with the fact that they're waiting. I think we both said it, but they're waiting down here at like 44 cents. I think you agreed with what I was saying. But anyway, we both are thinking the same thing. At 44 cents, roughly, look at this. At the bottom of this rising channel, I think there's easy money lining up at this rising channel, but we have to get a bounce somehow. We've got to push some of these shorts out real quick. And I think a push back up to the top of this descending triangle, even if we get rejected, would do it. Even if we just went to 534, anything that pushes us up to alleviate the daily time frame and get the technical traders out of here would be the perfect time to pull it back to 44. Imagine it goes up to 57 and everybody in the longs, the futures longs, like, oh my God, can shut it off. It's going up. We know it's at least coming up to the top of the channel. And then it dumps down real quick. Maybe even just a quick wick for a few hours down to 44.4, 44.2, maybe even 44.8, depending on when it hits. And then they've got that easy futures trade. At minimum, some would be like, oh, it's 8%. I don't think that's what they'd be looking for. To get a grand dump off like that, I think they'd be looking at that easy money for that 52% move back up to a rising channel resistance that's been there for almost 2.5, or what has it been? A year and a half right now. So just consider that. So anyhow, sorry, we have to go back to our regularly scheduled program now, and we have to stop learning. I apologize, and I know more of you will leave because every time I stop talking, guess what? Everybody decides to leave. So here's our man of the hour, Jerome Powell.
Make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about
what?
There are risks that would cause language in the statement.
Did he just say people write down for the March meeting what they think? I got to hear this again. I got to hear this again.
To signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have.
Can you look up and not read from your book?
If you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say I don't think that's probably not the most likely case, or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be one-off?
That's going to depend on the data. The whole thing is, this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on.
You're going to write down what you think?
We talked about there are risks that would cause us to go slow.
They're going to write down, you hear that at the March meeting, they're going to write down what they think. Excellent.
For example, stronger inflation, more persistent inflation. There are risks that would cause us to go, if they happened, it would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
I said, I'm sorry, I know a lot of you are going to leave.
Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity, and do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade?
Productivity, it's not a product.
So this is a really interesting question.
It's productivity, man. We're not selling not productivity. Productivity. How productive are we being? We're not talking about an actual product. Productivity and products are different, so it's not a productivity. I'm sorry, but this. Are you guys still enjoying the meeting? Like what do we expect to gain from here? Like for anybody who's actually watching, so 41, there's a reason why 41 of you have stuck around. What are you expecting to see from here on out? Is there anything you're hoping he says? I just want to know. And I promise I won't say another word. I just want to know. You can cancel this, Tom, somebody said. Yeah. Yep. And then just like Jimmy said, this is BS. Why not include costs of food and like food and energy, right? You know, because I don't know, that's the biggest, but you know, we can't live without our energy and food, especially where I live in the north. We can't live in the winters without energy. I'm waiting for him to use the words like stagnant cesspool. Well, we'll see. I mean, he's got a pretty big binder he's going through right now. In government, yep. Oh, to describe the I'm just waiting for it. I listen to it even though I want to beat my head through the wall, and sometimes it's hard to get through. We know we've only got 16 minutes and 28 seconds because it looks like it ended. There's no more time being added. So for the next 16 minutes, I guess he's going to lie to us, but at least maybe he'll use some of his key phrases. Like right now, the one thing I am learning, though, is the fact that they're not lowering rates except maybe for a one-off event anytime soon. Like, there's a lot of pain, and what he's even saying is we're basically going to stall this until after the election, maybe even lower rates one time to make it look good. But after the new president is in, and especially if Trump's in, we're going to raise rates like you've never seen before. Consider that.
And I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increase, or AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force, and activity returning and supply chains getting fixed.
Right, so would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity?
That's
right
one
now?
way to look at it, yeah.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices?
Gensler, does this lady have any relation to one known Gary Gensler? I wonder. I'm just curious. I've never heard anybody with the last name of Gensler in the media.
As you evaluate whether and when to cut rates, and it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives. But they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built-up set of cities, and people are moving further and further out, so that there hasn't been enough housing built, and these are not things that we have any tools to address.
He is cute,
but
though,
where it comes into play.
I just realized Jerome Powell is kind of a cute little old man. He's got big old ears for his tiny head, but a itty bitty little nose too, and he got little itty bitty glasses too, kind of for the size of everything. So I guess that's kind of nice. He's still got a decent head of hair too. You know, for I don't know how old he is, but well, I'm not going to say anymore.
Specifically in our work is
No, I was
inflation,
gonna say
which
no,
is a
you know.
combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case.
The stuff that,
So-
you know,
And
we need
just
to
real quick,
know.
what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly not most importantly, mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation, in the necessities of life, right away you're in trouble. Whereas even middle class people have some scope to absorb higher costs. So we have to it's our job. It's what.
He doesn't understand what the middle class means, does he? If you raise class on the middle class, if you raise the prices so much on the middle class, there's no money left. We turn into the lower middle class, or just the lower class. See, I think they're trying to get rid of the middle class. He obviously doesn't know what the middle class means. And the fact I stopped it at 1222, I always say when it stops on something with the 222, it's a sign of the angels, and I'm right. It means you're going, not that I'm right, but you're talking about the right stuff. But you got to get off the subject because then you get banned.
Society's asked us to do is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So
Put them on when Jerome's on a lot.
I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them. But we're at the beginning of that process, I would say.
Quick follow-up. Is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
I'm sorry, we need to review the data before I can make that decision. That's all you need to know for all these questions. He just needs to see the data. But next month he's going to say, I need to see the data. Every month he just needs to see the data. Will somebody give this man the damn data, please?
Yes, we do. We see those as independent tools.
I mean,
And
nobody
so
gives it to
they
them.
don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening in one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet run off to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March,
How long do you think it's
the
gonna take
implication
them
is
to bring
that
up the data,
8 good
Julie?
months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation.
I mean, what a
We just
fucking
want to make
moron.
sure that
That's
we
the
do
best
get
way
the
to
job
serve us,
done
Julie?
in a sustainable way.
When-
That's how we're thinking about it.
when the federal
in terms
debt-
of when
when the
that'll
budget-
be, that'll all come out of our communications, and we won't keep that a secret.
I guess letting the
Chair
budget
Powell.
just go out of
Evan
control
Reiser
is
with
just...
M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to zero, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to zero. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed.
Got to see the data first for February and March, Julie.
All of the issues that will be arising.
You'll hear they got to see the
next,
data.
let's say,
They have to. Got to see that data. I want to see the data.
Market Watch. I
thought they released the data.
Change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a third term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's
I
not
need to see the
something
data,
I'm
see how I
focused
pull.
on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on.
Consequential. That means they're going to do something unexpected at the end. I'm telling you, once this election's over, get ready. I think they're just building up the bend over ramp, and at the end of the year, it's going to be very, very bad. I can see it. They're going to butter us up to the election, and once they do it, they're going to cut our heads off. They're going to cut our heads off. They are. It's going to be bad. And then when he says what went wrong, he's going to say, I'm going to review the data in January.
Doing our jobs.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months. And you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last
3
6
rate
months
cuts
for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've got. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data, it kicks back up.
This guy with his data.
It'll go slower or later or both. If we got really good at inflation data soon, that would matter for both that would tell us that we could go sooner.
All right, jackass, what happens when the cost of oil goes up? Because God knows that we're at the bottom of a reversal pattern. What happens when the price of oil, like WTI oil, goes from $72 or $73 a barrel to $100? Your inflation data is going to reverse back up, and you can't even point to that as part of the data now. And now you're going to have to raise rates just to keep up. So everything he said, he never points to anything. It's Oh, I don't care about whatever. The Lions might have lost, but I mean, I'm wearing my champion. Everybody knows what I think about the Lions, and everybody knows who I really care about. Has anybody ever seen me wear the Lions one time in 3 years? I don't own any Lions. I would have liked to have seen them win the Super Bowl, but I don't like the NFL. My heart is with Michigan. So, that's not clear enough. I could wear this one too. It's just but yeah, I'm not the only thing that pissed me off about the Lions was Dan Campbell. I'll be honest. Dan Campbell pissed me off. Like, who doesn't kick a field goal? You're a Niners fan, perfect. So it's in San Francisco. You tell me, if we go up 17 and that's 3 possessions now, is it not the same? Or if we go up by, tie the game with 6 or 5 minutes to go instead of going for, you tell me. And then you come to is it rigged in the NFL? I can only see one scenario. In a rigged scenario, you wouldn't tie the game. Like, I don't understand. You're going to tell me with 6 minutes left you're not going to tie the game? And then with a minute left or 45 seconds when you have 3 timeouts, you're telling me he's running the ball on 3rd and goal and still going to call a timeout? What does it mean? You don't even... Why would you... You're not saving any time. You could have let it run to 20 seconds and it would have been just as good. Or 35 seconds. It was all... So that's why I don't watch the NFL. Back to some more scripts and rigs. Jerome Powell.
Perhaps go faster. So we're just going to be... but of course, we'll weigh that with all the other factors. We're setting policy based
Oh, he's
on
brought up the
totality
data many times now.
of the data.
See?
But just to follow, if inflation stays where it is currently, that
I don't know, the
would
data
mean
can
that the real
change, man.
interest
What aren't you
rate
hearing?
becomes more restrictive.
Right.
Would that mean you'd have to trim more,
I guarantee you
perhaps,
talk
than you
about
already
data.
factored in?
Okay, I don't know.
I think
I need to
if we came to the view that that inflation were that the 6-month inflation numbers, which are very close to 2, were in PCE world. If we came to if we thought that is really where we're going to be, then
said
yes, our
scripts
policy
and
would be in a
rigs.
different
I like
place.
that. I said
It would.
back to the scripts
But
and
you know,
rigs.
that's the whole point. Is we're trying to get comfortable and gain confidence that is where that inflation is on a sustainable path down to 2% or toward 2%.
What is this 2% genie anyhow, dude? What's so special? Why not 0%? Who the hell wants 2% year over year? How about 0%? What about that was
I just wondered
2%?
if I could get your comment on the recent consumer
Why not
confidence data. It
6%?
seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward?
Oh, let me get to page 17. Oh, yeah,
so
that's
it's
right.
been,
We need to review
it's
the
been
data.
interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case. And we've asked ourselves why that is. And one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago.
Oh my God! See? He made you wait how long? An hour? Are you guys listening to this? Is anybody still here with me? Is anybody still awake? He just for the first time in an hour said something real. Listen to this. If somebody responds, I will play this and not say another word. But are you hearing this? What happened? They're going to have to cut his mic. Did you hear him? Finally, we're going to get our, remember what we say? Our 45 seconds to 1.5 minutes. You get it right at the end. Here it is. Tanya, Joe, Mr. X, Randad. You guys are all seeing this. Crypto Scrooge, make sure you follow him on YouTube. He deserves more viewers or subscribers. Maybe not, well, he gets viewers, but subscribers. I think more people should subscribe. Gerardo, yeah, exactly. Jose, yeah, see? Ready? Let's listen to this again. He just said the prices in the stores are much higher than, or are higher than 2%, and they're much higher, yada, yada. So he's admitting, finally, let's listen to the real.
Inflation and falling inflation perhaps has played a role in that. And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case. And we've asked ourselves why that is. And one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why.
No, that's all of it.
Happy, and they're right.
It's
to
all
be
of it.
happy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this.
Okay, everybody. For the ones who are still gutting this out, if you're doing your job, what's his job? It's to contract the money supply, which means quantitative tightening until the end of time, until we get it right. That means 15, 20% interest rates. I'm sorry, folks, but that's what has to be done. maybe worse. But you cannot continue to expand the money supply and sit here with a straight face and say we have to do what needs to be done, while with the right hand saying this and with the left hand you're pulling the lever to print more money. Like, get the fuck out of here. If you're expanding the money supply, it's going to continue to be more expensive when you go to the store. More money printed, more money out of our pocket. How else? What's the biggest tax to man? The inflation tax. Someone's got to pay for it. Someone's got to pay the national debt to the central bankers. I'm sorry, I'm saying too much and I'll get banned, but that's the honest to God truth. You cannot tell me that you need to do your job while you're expanding the money supply. The only way to bring prices down for me and you, for goods, for anything to live, energy, food, housing, is to contract the money supply. That's why they can't sit here with a straight face and tell you, hey, we're winning the fight against inflation. Bullshit. You can't win the fight if the money supply has expanded. Your national debt has expanded. You're losing. That means after the election, we're screwed. You can only push it out for so far. We're in bizarro world. We're literally in bizarro world. Get ready for the next chapter. It's going to be fan-fucking-tastic.
In terms of you're right. In recent
But in better news, it's 36 degrees here in the great state of Michigan. Humidity's awfully high, but not quite as hot as it is right now when you try to, just remember, this is why I try to come on I'm on every single day, but this is why I preach the precious metals. I preach getting out of currency and into real money. So I preach getting into the Internet of Things tokens and the ISO tokens, not just XRP, which is also an ISO token. But you need to hit them from every angle going forward. And guess what? At some point, at some time, we're not going to be on the downturn anymore. Like precious metals with gold is trying to make a floor. It's trying to floor itself at 2,000. We'll see how successful it is, but think about that. Silver right now is not even, 55% of all-time highs. Why are we still in an overinflated dollar? That's my question to you if you're not buying precious metals, in particular silver right now, at an 88 spot, 41 to 1 to gold, which means you have to buy 88 plus ounces of silver to equal 1 ounce of gold. So if it goes back to 40, you can trade out 40 ounces, keep the rest, and get an ounce of gold. It's the 50% off trick. Been trying to teach everybody for years. And I get a little irritated the longer we go because of guys like this. So I know our time it's getting smaller and shorter and shorter. 2021, I laugh because we had 7 years. 2022, we have 6 years. 2023, I say, okay, it's going to be kind of kicking us in the nuts here after we get through 24. Now we're already through the first month of 24. We have less than 5 years max. 4 years until 28. Once the last bank/financial institution gets off of the old Swift HTML framework and goes to the ISO framework and the IoT, the Internet of Things within the smart housing takes over, and then you get the Agenda 2032, the UN agenda. Once you get through all of these in succession, you're out of time. It seems like a long time, but 28 to 32 is going to suck balls. And I'm not even going to sugarcoat it. It's going to suck. And I'm sorry, suck. It's going to suck groteskies. But who knows? We could be bouncing balls. We could be playing baseball. Who the hell knows? But it's not going to be pretty. So if you're not doing it now, when are you going to do it? So far, you've had 3 beautiful years with me almost going on March where you could have been building something. And I gave everybody the opportunity to build in 21 when we had 400% gains in crypto in 2 months. And I showed you how to wait for gold and precious metals to go down, and I dropped 12 grand. Everybody should remember, or 10 grand on air through pressure. I bought gold, I bought silver. Gold was down I was close to 1,600 when I was trying to get people to buy it. At that peak, we had silver down near 16, 17. I was begging people because I know what's going to happen. Even if we get back down there, you don't understand. Go back to 2008 or 2011 when the prices came way down. You had like 3 days and then it went up significantly. And even trying to buy it, they were all, even if you can buy it, it's not available. All the big time people are buying it. So it's like you got to buy it and you got to find a way to do it when the time's right. What better time than when the dollar's overinflated? If you're a country that relies on the US dollar, you understand what I'm saying as well, because it's never been harder for you. It's even harder for you than it is for us, except if you export something, because we don't export a damn thing. Believe it or not, even the cars that we say are built in America, we got to get the seats from Canada. We got to get the engine from somewhere else. Hell, we might make the fucking rubber for the tire. I'm not even joking. We might make the fucking nail or the bolt to tighten something, but we're not making the parts. It's a tragedy what's happened. So the point here is, because this is the last you're probably going to hear from me, this is going to be over after this. Get ready. And if you've stuck around for this long, there's very few people that are going to hear the message and are actually going to be part of the solution. But if you actually watch and take notes and actually do what I do when I show you every single day, when I'm expanding into something, or when I'm saying it's the accumulation phase, or when I'm saying with precious metals, and how crypto, especially if you have the right tokens, they have to be Internet of Things or the ISO, Internet of Things, smart houses, smart cities, 30-minute, you've all heard of the 90-minute city. 3-mile cities, 90-minute cities, you can get anywhere in 90 minutes. That's your expansion zone, that's your radius. That's controlled by the IoT, the Internet of Things. That's how you get all the smart things controlling the smart people, right? And I say the smart people that, are woke.
Surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for taking our questions. Brian Menacien in business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data is subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy. And I always feel like I spent most of my life in the private sector looking at individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone. That in all their districts, they're talking to, not just the business community, but the educational, medical, all nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But that they come back, and what each reserve bank president does is during the outlook go around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk up. They will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Jeff Cox for the last question.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation, are really the main thing we're looking at. Of course, we want the labor market to remain strong too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
All right, that's it, everybody. Thank you so much for tuning in. Devin, 200 plus ounces. Yes, the journey to 200 more. Have a blessed afternoon, everybody. I'm going to go. I know that was a long, boring, drawn-out segment, but I do thank everybody who stayed tuned. I thank the 65 people for hitting that like button. And I know it's not popular. It's not the funnest thing to watch, but guess what? You learned a lot. Maybe you didn't, but at least when you've seen some of the charts and you've seen the reactions of this, I'm telling you something with crypto. It kind of feels like in the daily time frame, it needs to have some kind of come up here. So I'm going to be curious to see exactly what's going to transpire here.